Solo 401k, SEP-IRA, Mega Backdoor Roth, Cash Flow and Taxes, Module 7. Most coaches I talk to are leaving 5 figures a year in tax-sheltered retirement capacity on the table. Not because they can't afford to use it, because nobody told them it was there. The retirement moves available to an S-corp solo coach are materially different from what a W-2 employee can do, and they're almost never explained correctly for self-employed people. This video fixes that. 3 vehicles, the mechanics of each, the contribution limits for 2026, and the math at 2 income levels so you can see the actual shelter capacity. Source for all limits, IRS Publication 560, Retirement Plans for Small Business. I'll cite it by number because most coaches have never looked at it, and they should. 3 vehicles, defined before we touch the math. The Solo 401k, available to business owners with no full-time W-2 employees other than a spouse. You contribute as both employee and employer. 2 contribution streams, 1 plan. The higher capacity of the 3 vehicles at most income levels. The SEP-IRA, simpler to set up. Employer contribution only. No separate employee deferral. The simplicity costs you capacity. The Mega Backdoor Roth, a mechanism inside some solo 401k plans. After-tax contributions with in-plan Roth conversion. Requires a plan that explicitly allows it. Not all custodians do. We'll cover the Custodian Gotcha specifically. All limits per IRS Publication 560. Adjust annually per cost of living announcement. The 2026 contribution limits. Solo 401k employee deferral limit, $23,500. Employer contribution, up to 25% of your W-2 salary from the S-corp. Combined total maximum, $70,000. If you're 50 or older, add the catch-up contribution of $7,500, total $77,500. SEP-IRA, no employee deferral, employer contribution only, up to 25% of W-2 salary for S-corp, capped at $70,000. Same ceiling as solo 401k on the employer side, but no employee deferral component. The gap between the 2 vehicles at the same income level, $23,500 per year, every year. Source, IRS Publication 560. The table on screen shows this side by side. Solo 401k, employee deferral $23,500, employer contribution up to 25% of W-2 salary, total cap $70,000. SEP-IRA, employee deferral 0. Employer contribution up to 25% of W-2 salary, total cap $70,000. The employer contribution ceiling is identical. The difference is entirely in the employee deferral lane. And that lane doesn't exist in a SEP-IRA. At a 32% marginal tax rate, $23,500 in additional shelter equals $7,520 in immediate federal tax reduction. Per year. Every year. One more comparison worth stating explicitly. Under sole proprietorship or a disregarded entity LLC, not an S-corp, the employer contribution calculation for a solo 401k is different. It's 20% of net self-employment income after the SE tax deduction, not 25% of W-2 salary. The S-corp structure produces a higher employer contribution ceiling at equivalent income levels because of how the salary and distribution split works. This is one of the downstream benefits of the S-corp election that doesn't show up in the SE tax savings calculation alone. At a $65,000 W-2 salary from your S-corp, the declared assumption from the break-even video. Employer contribution ceiling, $65,000 times 25% equals $16,250. Plus, employee deferral, $23,500. Total pre-tax solo 401k capacity, $39,750. SEP-IRA at the same salary, $16,250. No employee deferral. Gap, $23,500 per year. These are the numbers in IRS Publication 560. Not invented. Read out loud because most coaches never do. At a $100,000 W-2 salary, a higher salary assumption for coaches at higher income levels. Employer contribution ceiling. 100,000 times 25% equals $25,000. Plus employee deferral. 23,500. Total. 48,500 in pre-tax solo 401k shelter. SEP-IRA at the same salary. 25,000. Gap. Still 23,500 per year. The employee deferral is the constant. The employer contribution scales with your salary up to the IRS compensation ceiling, which is $345,000 in 2026. Pause here for a calculation moment. Pull up a calculator. Take your W-2 salary from your S-corp, or your planned salary if you haven't elected yet. Multiply by 25%. Add 23,500. That's your solo 401k pre-tax ceiling for 2026. Compare it to what you actually contributed last year. The gap is a concrete dollar figure representing unused capacity, and the math just told you what it costs to leave it unused. The Mega Backdoor Roth, the layer most coaches haven't heard of. At the $65,000 salary level, you've used $39,750 of your $70,000 annual limit. That leaves $30,250 in remaining capacity. If your solo 401k plan allows after-tax contributions with in-plan Roth conversion, the legal basis is IRS Notice 2014-54. You can put up to $30,250 in after-tax dollars into the plan and convert it to Roth inside the plan. Money you've already paid income tax on. It grows tax-free from that point. Tax-free at withdrawal in retirement. The pre-tax contribution saves you money now. The after-tax Roth contribution saves you money at retirement. Both legal. Both inside the same plan. Neither available in a SEP-IRA. Custodian reality. Not all solo 401k plans allow after-tax contributions. Plans that do. Fidelity Self-Employed 401k. After-tax contributions allowed. In-plan Roth conversion is a manual process. E-Trade's individual 401k. Similar provisions. Solo 401k by Neighbors Group and MySolo401k.net. Purpose-built Solo K administrators that explicitly support the Mega Backdoor Roth structure. Vanguard Individual 401k does not allow after-tax contributions. A coach who chooses Vanguard for its fund costs cannot execute the Mega Backdoor Roth. The plan provisions, not just the fund selection, determine what moves are available to you. These are provider examples for planning, not endorsements. Verify current plan documents before contributing. The custodian table on screen summarizes this. Fidelity. After-tax allowed, manual conversion process. E-Trade, after-tax allowed. Neighbors Group, MySolo401k.net, after-tax allowed, designed specifically for this. Vanguard, no after-tax contributions. If the Mega Backdoor Roth matters to your retirement strategy, and at the right income level it should, verify plan provisions before you open the account. Opening an account and then discovering the provision isn't there is an avoidable mistake. One more limit worth naming, the catch-up contribution for coaches 50 and older. The standard employee deferral for 2026 is $23,500. If you're 50 or older, you can add $7,500 in catch-up contributions. Total employee deferral capacity, $31,000. Combined with the employer contribution at a $65,000 salary, $31,000 plus $16,250 equals $47,250 in pre-tax solo 401k shelter. Source: IRS Publication 560. All limits adjust annually per COLA. Flag your renewal calendar to check the updated numbers each January. The December 31st deadline. This is a hard stop. Solo 401k contributions can be made until the tax filing deadline, including extensions, October 15th of the following year. But the plan itself must be established. Documents executed, account open before December 31st of the tax year you intend to contribute for. Missing December 31 means losing that entire tax year's contribution capacity. This is the mistake that catches coaches who think about retirement vehicles at tax time in January or February. The plan establishment is a fourth quarter operator task. Put it on the calendar now. The retirement contribution ceiling calculator in the lesson resources takes your W-2 salary, your age, 50-plus flag for catch-up, and your total net income. It outputs maximum pre-tax contribution, maximum after-tax Roth contribution if your plan allows it, SEP-IRA comparison, and total annual tax impact at your estimated marginal rate. Run your own numbers. Compare the output against what you actually contributed last year. The gap is a concrete dollar figure representing unused capacity. Next, the money you're spending to protect what you've built, insurance and contracts.